For our COBT listeners and viewers, it's Maynard, Arjun, and Jeff here with something that I feel like I'll confess is my personal fantasy. For the next hour or so, I'm going to get to hang out with my favorite research analysts, current and former. But in particular, we've got the team from Goldman Sachs here with us, Neil Mehta, Carly Davenport, and Brian Singer. In another life, I got to work with them. In another life, Arjun absolutely got to work with them. But they are coming off of the Miami conference. You know, we're 2 weeks into the world, and you know we've had I think 2 weeks of the year, and you know about 6 months of activity in these 2 weeks, as has been the case with energy, power, and all the rest over the last few years. So let me stop talking and just say, Neil, thank you so much for your friendship. Carly, always love having you. Brian, ditto. Having the three of you is it's a shish kebab of knowledge that we can't wait to dive into.
Well, we're honored to be here, Maynard, Arjun, Jeff, and I will say that the sessions that Veriton participated in, particularly Arjun, some of his taglines that we got from the conference, including talking about inspiring us to take more risks, were the things that were talked about a lot in the hallway. So we love the partnership, and it's great honor to be here.
It's great to be with old friends and current friends, and you know we wouldn't be here if it wasn't for both of you. So
hopefully it's not a risk coming on our podcast. This is meant to be a semi-safe and friendly space.
Yeah, so. Neil's taking it to heart. Take risk. Okay, fine. I'll do COBT. Well, look again. Thank you, and thank you. We did have a team there, and all the reports were great as usual. It's always the slot that kicks off the year. Maybe I'll jump in, and this will be free flowing, probably more than usual. But Neil, maybe for everybody's benefit, for those who weren't there, when you thought about the menu, and what are the themes, and who do you want to profile, and how do we build it for today's taste? What was your mindset going into this year, and how was it different than maybe the last year or two?
You know, when I was able to take the integrated seat from Arjun, when Arjun gave me that opportunity in 2014, energy was 10% of the S&P, right? And so we would be able to do a standalone conference that at that point Brian ran that was dedicated to oil and gas. Over time, Maynard, energy's become 3% of the S&P. Utilities are 3% of the S&P. Materials are 2 to 3% of the S&P. And then some of the adjacent spaces around it, like clean energy, nuclear, make up 1 to 2% of the S&P. And so we've been able to kind of recreate this conference and still able to get the generalist interest, hopefully, and the attendance that we want to achieve, but we have broadened out the space. And with the enormous amount of consolidation that we've had in this industry, we're still able to get 100 to 125 companies, but they are much broader than they used to be. So to me, this conference was I thought it was the most fun yet, because you could jump from a panel talking about construction of solar to a session about uranium, to a session about natural gas, to a session about refining, to a session about Canadian oil sands. And I think it reflects how much we as a community have progressed in our knowledge from really being specialists in an important area, oil and gas, to really being broader. And I think Veriton also reflects that as well. And I think that as we develop the menu for this conference is something that we really want to highlight. And that was reflected in the keynotes. Of course, we had the leader of one of the key leaders of the oil and gas industry in Ryan Lance providing the keynote. But we also had Talon Energy and Mac McFarland providing a keynote. And then we had a policy perspective from Chris Wright with the third keynote. And so I think it reflects the conference has evolved. We have all evolved to be broader. And I think it's a good thing for all of our careers. But I think it's reflective of also the challenges of the CEOs who are listening to this call to also understand that they're not competing for capital against another E&P or another refiner. They have to compete for capital against a broader natural resources ecosystem. And so being wider is going to be critical for relevance.
Maybe I could just ask you, Neil. So this was, the first full week of the year, and it happened right on top of, the Maduro thing had just happened. What would you say, just that piece alone, not just Venezuela oil, that obvious part of the macro, but the reminder of the geopolitical things can happen fast. National security matters in all of this. Like, how would you just isolate the Venezuela effect on the discussions?
There are three observations of it as well. One is it's fascinating to see how information is now reflected in the market. And so the headlines hit around Venezuela, and the first reaction was some of the stocks that were impacted by it went up a lot. PBF intraday on Monday morning was up 20%. Valero at one point was up 13% on Monday. Schlumberger was up 13% intraday on Monday. And so I think the first observation is that we're in a different market regime where people take a data point and extrapolate it, give you the full benefit or full cost of it often on day one. And then over time, there's a moderate, as people kind of calibrate and get the actual earnings impact and have a better sense of what the P50 is, you start to grind back down towards what I think is a more reasonable or efficient pricing mechanism. So I think that was the first observation, is we're entering into a different market regime where we are definitely trading headlines, and we trade headlines to extremes. And then we do the numbers on the back end of what the impact is. So the headline on the first day was Venezuela is 900,000 barrels a day. A couple of years ago, it was 2.5 million barrels a day. So we were going to add 1.5 million barrels a day back into the market. I think what evolved over the course of the conference with comments from Chevron and Conoco, and we had the honor of having John Hess as being a key speaker, and MPC and Phillips 66 and Valera, we got a much better perspective that it's hard to bring barrels back online in Venezuela. And I think the market consensus coming out of the conference was it's not 1.5 million barrels a day likely to come back in the next couple of years. It's like 500,000 barrels a day if things go well. And that got validated by the conversation with President Trump on Friday, where I think the companies expressed some of their understandable concerns about, the environment that they need to invest in Venezuela. So I'd say the third piece of it is that it goes back to, I think, one of the taglines from Chris Wright in his session: energy matters. I think that is something that Arjun instilled in a lot of us. People don't go to war over their iPhones. They do go to war over their energy. And so I think what I think was a realization is of the importance of energy as a sector. And I think we've had a lot of those reality check moments over the last couple of years. Certainly power last year, the Ukraine-Russia war on natural gas a couple of years before that. But I think this does remind you that energy is the heart of a lot of the most important debates of our time. And it's not just about stock picking, it's about life. And I think that was certainly a key takeaway as well. So one is the market has a tendency to overreact. Two is, I think over time, people got a more realistic assessment of what Venezuela could be. Even if Venezuela is smaller, point three would be, it still is a reminder of how fundamental this sector is to some of the most important debates of our time.
Well, I'm going to try not to monopolize this conversation, but this is like really fun for me, so I might, but I won't, I promise. But I was thinking, Neil, you described this soup now, like we're doing, and that's a good thing. We're doing the full gamut, and we're bringing in all the angles, and it's making it really interesting and exciting, and there's all sorts of things to think about. Does it also, Carly and Brian, maybe I'll ask you guys, does it sand down the edges around what energy suffered from, let's say 5, 6, 7 years ago, which was the us versus them? It's my solution, it's your solution. This is green, this is not green. Now when you do the soup and everybody has to hang out with each other and realize the interdependencies, Have we sanded down the edges between the sectors, I guess is my question.
I might take a start at that, Maynard. I think one of the differences is that we are now in an environment of a material increase in demand growth for power in a way that I think for a lot of the years, the decade leading up to this, we weren't. And so there is actually a little bit less luxury to have some of these debates over, is it going to be this fuel? Is it going to be that fuel? And frankly, even going back to the conference a year ago, where we had already been in maybe year one of this big uplift in data center power demand, there still was the discussion of, is all of the power going to come just from natural gas, or is it going to come just from nuclear or just from renewables? And we don't think we're in this no or environment, to use an improv comedy phrase. We're in a yes and environment, because 2.6% power demand growth CAGR through the end of the decade, which is Carly's forecast, that's going to lift a lot of boats. And some of those boats are going to be colored green, and some of these boats are not. And I think there was a lot more recognition, and there is today, whether it's from the government, whether it is from corporates, whether it is from households, on the need for reliability, and that's requiring more investment in the face of not only demand growth, but aging infrastructure, and then also physical risk, and trying to mitigate any of those risks.
I would maybe just add to that. I think we've even seen that play out in our conversations with investors, and those conversations have broadened out significantly outside of just, talking to specialized power and utility folks. And now we are talking to broader energy investors, broader industrials investors, even tech investors that are looking to better understand this value chain that they've now been sort of thrown into, and trying to understand how everything works. So I think we've seen that manifest itself as well, not only in the decisions that deployers of capital are making, but also among the corporates community as well.
So does that mean, Carly, that the soup that we are putting on stage and talking about now, are your investing clients also organizing themselves a little bit like that, and they can come and they're free to buy anything on that menu? Talk to us about that.
I think we have increasingly seen that play out, especially across the power landscape. I mean, we talk to investors who are looking at it from a tech perspective, or maybe they're looking at the specialty contractors, or maybe they're increasingly looking at some of these oil service companies who are stepping into the power space, or some of Neil's coverage that's working to step into the power space. It all feels like the lines are blurring, and I think the investment mandates have expanded with that.
Brian, I was thinking I didn't do this kind of fully in the lead in, but Neil is in the oil and gas, the classical vertical there. Carly's in utilities and the natural gas, everything that goes with that. Your mandate is interesting, Brian. It's unique, and I was just wondering if you would talk about your sustainability, reliability lens on all these things. I think that's it's unique, so I want to make sure people understand it.
Yeah, sure. So, I'll hit on just like what do we think sustainability looks like in 2026, Maynard, and then I can kind of dovetail into reliability and kind of the big questions that we think are out there. The roots of sustainability and sustainable investing are really all about risk mitigation and long-term returns. It's identifying drivers of risk, companies mitigating risk, revenue beneficiaries from investment towards risk mitigation, and the companies that are likely to have favorable competitive positioning and return on capital. To use a paraphrase from the movie Meet the Parents or Meet the Fockers, you had the character played by Robert De Niro who elevated this phrase, circle of trust. And to bring that into today's conversation, for many years, the global circle of trust has been quite wide, as you've had flexible and affordable global trade, you've had available resources, you've had available labor that's minimized the redundancies needed for infrastructure backup. And you asked earlier about the green side. During that time, rightly or wrongly, sustainability became overly associated with decarbonization, because that was a major risk and area of focus. But over the last arguably 7 years or so, we've seen a narrowing of this circle of trust, and you now have so many other risks. And it's really, that's what's dominating, we think, the boardroom conversations. Will we have enough power? Will we have enough or sometimes too much water? Will networks go down? Will we have supply chain outages? Will we have too little or too much labor? Will we be able to afford it all? Are we a greater physical risk? How will AI impact competitive positioning? So in that more traditional way, we think sustainability is actually very much front and center, and it just in maybe a little bit of a different way than where it had come from. If we then transition to, I think, the two big questions of the day for 2026, the first is, are AI's innovations and AI's impact sufficiently defined where the big companies of the world or governments of the world can cut their investments without perceiving risk to their competitive positioning? We think the answer to that question is no, or not yet. And that means continued need for infrastructure spend. And then the second big question goes back to the circle of trust. Are we going to see it widen back out where there's no longer worry about outages of power, water, supply chains, and networks? And it doesn't look like the answer to that is yes. We think it's also no, or not yet. That means the continued need for infrastructure spend. And so that really reinforces that we're not in the first inning, but there's still a lot of innings to go in this reliability investment opportunity, because that is a key focus, and it's requiring more investment to keep the lights on, keep the water running, keep the water clean.
I hope Neil will forgive me. I'm going to start with a power question that's probably for a mixture of Brian and Carly, maybe a little bit of a sign of the times. Brian, you had a great framework. I think it was when we worked together, it was certainly after when you were covering the E&Ps about the shale cycle. And discovery is always exciting. You then go through the hopes and dreams phase before you really have to do anything, and that's especially exciting. And at some point you have to execute, and you separate from some of the winners and losers. And I think just before the conference, under your new rubric of the sort of broader sustain and maybe your generalist portfolio manager approach, you applied that to AI. And I'm curious about how you think about it in the power sector. We have tried and true stuff like solar and natural gas. We have a new excitement, maybe justified, maybe not, about SMRs and nuclear. We have all these different areas. How do you think about moving? We've clearly been in a hopes and dreams phase. ChatGPT was discovery. 2023, people kind of started trading up the IPPs, and now a whole bunch of infrastructure names with it. We're in year 4 of this. And I wonder if you could just expand, you or Carly, on where you think we are in the power cycle. I think your note might have been more about AI specifically, but how do we think about power? Have we moved into the execution phase? What are the things we should remember about shale? Not all of it applies, but maybe you could just expand upon that.
So Arjun, maybe I'll talk about it a little bit through the lens of AI, and then I'll turn it over to Carly on how do we think about power sourcing and what may or may not occur. We did see this very clear shift in shale when we went into that execution phase and away from the appraisal hopes and dreams phase. There were really 3 catalysts for that transition, and many of the people I'm sure that are listening to this call were a part of that and remember it. The first is we went into oversupply. The second is that financial flexibility eroded, and the third is that corporate returns eroded. So if we think about and use that framework, are we seeing any of those boxes be checked today? Well, last year was a year in which we saw a lot of efficiency gains, DeepSeek, we saw new generations of servers, but it didn't really impact budgets because AI is still perceived as both a competitive, an existential opportunity and an existential threat. And until that's not the case, then it's hard to argue that we're going to be in oversupply, even as we're seeing more compute and more token ability, so to speak, hit the system. Financial flexibility, reinvestment rates of operating cash flow back into CapEx for shale companies was 110 to 140%. And that's when it really did start to get extraordinarily tight. We are not there yet for the hyperscalers. Yes, there's one that is at that range or above, but in aggregate, the 8 major hyperscalers still have 20% of their operating cash flow left as free cash flow, even after the budget increases that we have seen and are projected to see. So we wouldn't say that we're at a point of financial inflexibility. And then if we look at corporate return on capital, the hyperscalers have been between this range of 24 and 31%, and they're still at the upper end of that range. The projections by our analysts would call for a little bit of degradation, something that we're watching, but not really enough to, we think, say we have shifted away from that. And that's why we think it will be important, because the setup and the investment opportunities will shift. It'll become a lot more of a stock picking environment from a thematic environment at that time. And once we do make that shift, it means budgets will come down in response to efficiency gains. as opposed to go up. So I know I didn't answer exactly your question as we related it to the power technologies, but I figured I'd turn it over to Carly on the sourcing.
Yeah, I mean, on the power side, we have been framing this year more as a stock pickers market versus an own the theme market. And I think it is shaping up to be an inflection year from shifting opportunities and options that were put on the table in 2025 into concrete PPA announcements and even rationalization of some of the load growth pipelines that we've seen. And I think we've already started to see that play out this year, whether it was the Meta PPA with Vistra or M&A announced both with Vistra and Talon, or even the reductions in the load growth outlook from both PJM and ERCOT over the last couple of months. So it has started out as a year of rationalization, and we do think that that will put more focus on the haves and have-nots and who was able to actually execute on some of these opportunities. As we think about the opportunities across the different power sourcing, generation types, we think it still is in all of the above approach. And I think we think of it more from a duration standpoint. So near term, we think you'll see fewer coal retirements, increased utilization on the gas fleet, and you'll still see renewables, in particular, utility scale solar plus storage built out to meet the gaps in supply and demand. Medium term, we're still bullish on the gas build. We have about 10 gigawatts per year of natural gas getting added to the grid through 2030. That's across both CCGTs and simple cycle units. You'll have some nuclear sprinkled in there as well. We currently only embed these restarts. So that gives you, call it 2 gigawatts or so of incremental capacity. But we think the SMRs and the new large light water reactors are likely longer dated, probably mid 2030s from that standpoint. And then long term, so that's the nuclear opportunity there. So really the levers to pull in the near term are coal and gas on the existing fleet.
Carly, just maybe a follow-up. So I've written about this in Super Spiked, which was what did I learn from the oil super cycle? And I call it the quadrilateral of death, where for the first 4 years, 2002 to 2006, oil prices went up and profitability went up, either cash on cash returns or the book return on capital employed. And I always say my biggest regret is that from 06 to 08, oil went from 60 to 100 and returns on capital started flatlining. So we added a lot to the oil price, but it was the first signs that overinvestment and all this kind of stuff was happening. And of course, the most disappointing period is that we actually stayed at $100 oil from 2010 to 14, and returns on capital collapsed from 20% back to the 8 or 9% that they were at when oil was just $20 a barrel. I don't think that framework necessarily applies to certainly regulated utilities, and I'm not sure if they apply even to some of the power infrastructure names. You did mention some of the red flags, maybe some of the peak demand forecasts have come down a little bit. At the company level, how do you think about what would be your warning sign? Some things have gone too far, where I don't think it's a valuation thing, but is there an equivalent metric to the return on capital metrics we would have used that I missed, just for the record, by the way? Biggest regret as an analyst at Goldman Sachs?
Yeah, I mean, I think, the IPPs, at least that we covered, they've been quite disciplined from a capital deployment standpoint. We've not seen a lot of new build announcements. And I think if you saw that shift and really saw a chasing of the potential increase in prices, really that we, frankly, haven't even seen materialize yet. I mean, in particular in Texas, right? Pricing was under $35 a megawatt hour last year. You haven't seen a lot of price formation. So this is all on the expectation of price increases. So relative to oil, where you actually did see the price move, you haven't really seen forward curves for power prices move much. And so I think we would be concerned if you started to see power companies chase new build. And that we've seen very little of right now. I think in part because you've still been able to pick up some assets in the M&A market much cheaper relative to the cost of new build, at least for natural gas.
Yeah, no, I wanted to, Neil, as you were kicking us off, you mentioned upstream companies taking risk. So I'd like to hear, just kind of fleshing out that discussion. You're in this period where, debate what the degree of oversupply is or isn't, but the perception is we're, near-term oversupplied in oil. This is a sector that hasn't been loved by the market, yet I think we can see, potential opportunity for companies that can fill that growth wedge, in the out years. Maybe just talk about, the investor receptivity to risk taking, and, maybe just some advice for companies as they start to toe into that. And, how do you speak to the market about taking that risk?
Yeah, I'll share my perspective. I would love Arjun to repeat what he shared at the conference. I think we all got a lot out of it. We are not in a structural down cycle in energy. We think we are in a cyclical down cycle. So that's the difference. I had the benefit of covering coal. Thanks, Arjun and Brian, for that opportunity. That was a structural down cycle. That was and so that was an opportunity. That's where you wanted companies to invest their capex below DNA and shrink the business to create value. This is a cyclical air pocket where the market is oversupplied. Oil likely drifts lower, ex geopolitics in the very near term. In a DCF equation of the next 20 to 30 years, Jeff, it doesn't really matter that much, is why the equities are outperforming the commodity. And so then the question is, in these periods of commodity softness, what can our companies do to make their businesses better? So I think there are a couple things that come to mind. The first is M&A. I do think we are in a unique period of around consolidation. There's some urgency to potentially get larger scale M&A done with this administration. Having only a couple of years left, and it's going to be easier to get deals done in this administration than maybe in the last administration. So we'll see how whether that plays out. But I do expect 26 to be an active year around M&A. At this moment in time, maybe not. It's a very uncertain gas market. It's a very uncertain oil market. But don't be afraid to make your business better and even do things that might be dilutive to your free cash flow per share in year one if it creates value from an asset perspective, years 3 to 5. The second piece I would say is that this is a unique opportunity for management teams to look internally and think about the next generation. We've actually had a lot of good CEOs that came out of the 2016 down cycle and have reinvented their companies to over the last decade to be much more competitive in periods of times of commodity softness, and are much more focused on return on capital, and are much better capital allocators. One of the things that investors worry about is who's going to take over these businesses when some of these very good CEOs retire, and that can create overhangs on stocks, but also create social issues sometimes around M&A, and so I think making sure that you are developing the next generation of talent, have very clear succession plans, but also are using opportunities like the Goldman conference, like your earnings calls, to make sure that the next generation is visible and engaged with the market. People do not like when there's dramatic management change and they do not know who the actors who involved are. And we've had a couple of pretty high-profile incidences in the last couple of months of surprising CFO changes, for example, and the stocks have not reacted well to that. And so I think you have to make sure that you are taking risk as well by bringing that next generation out to the market, and making sure that they have an opportunity to hear what we as an investment community think. By the way, we as an investment community change our mind every couple months, right? And certainly the sell side does. I think we have a lot of investors who can be a little bit more thoughtful and long term, but I think it's important to hear that perspective and use it as a data point. I think the third piece of it is thinking about what your business looks like into next decade, and how do I get growth vectors in the natural resources complex? Without calling out specific names, there are services companies that are thinking very actively about power. Devon has an investment in Fervo and enhanced geothermal. That seems like a super cool technology. There are companies who are thinking about what is the next growth area, but that's a conversation that has to happen in 2026 as you build out 2031 to 2040. So one of the things I really enjoyed at the conference was hearing Chevron talk about all the interesting things that they're doing around the world. Is Venezuela going to materially move the needle in our Chevron model in this decade? Probably not. But could it be interesting next decade, depending on how it unfolds? It could be. Argentina, same thing, doesn't really move the needle in the Chevron model this decade, but they're building some optionality for next decade. Iraq, they talked a lot about that at the conference as well. And so I think don't be afraid to do things that might cost you a little bit of money right now to create optionality for next decade. That optionality, Jeff, might not be in the United States because we haven't found a lot of big oil fields in the United States. I think that's so don't be afraid to pursue international if it is a core competency of yours. And if it is not a core competency of yours, that is not a calculated risk. So I would say, Arjun's message of taking risk was a really good one. I think the only asterisk we would put on it, I think Arjun would put on it too, is risk also needs to be thought of on a Sharpe ratio basis. We don't want to take risks outside of your core competency. Otherwise, you're no better than a European major who did this and blew themselves up in the process because they were chasing a shiny object, which wasn't a core competency of theirs. But I don't know. Arjun, I don't know if that resonates.
Maybe I'll just add one addendum. Everything you said made a lot of sense. And I think at Veriden, we're appreciative of sort of like, how do you think about this over the next decade is what we're trying to do. I think I think you gave some great sort of guideposts to how you think companies should think about this. I think the tricky thing for especially maybe more the upstream oriented names in the US is it's been so shale the last 15 years and such a trend of either not doing or divesting your international exposure. It's one thing for some of those larger, they remained either integrated or diversified to kind of go to some of these newer countries. But I mean, my example is always Panhandle Eastern spun out Anadarko, was an onshore gas producer. And one of my first big analyst calls going back a gazillion years was that Algerian discovery. And I just can't imagine an onshore shale producer saying they're going back to Algeria to discover oil. We didn't bid up the stock till the discovery's made, but nor did we think it was the end of the world either. And I feel like it would be more treated as the end of the world right now. How do you think about some of those guys who maybe, I'll say, not the greatest word, but trapped in the US?
Yeah, well, so I think EOG will be an interesting case study because they've got some interesting optionality in UAE that they talked about at the conference. And then you have a company that I think has struggled to find incremental oil exploration, found a lot of interesting gas in places like Utica and oil-rich areas of Ohio as well, but I think not the traditional Bakken, Eagle Ford, Delaware. I'm very excited about some of the optionality that they have there. So that'll be a company that I think has that capability. But I think you're right, Arjun. A lot of these companies have shed their diversified capability and their ability to operate on the conventional side and to have the apparatus to negotiate fiscal terms and handled above ground issues. And I think that's where the big oils are actually very well positioned for the world that we might be moving into because they have that ability to operate in these tougher areas. And I think for the U.S. Land companies, the pure play shale E&Ps, it does get a little trickier. And that's where mergers of equals can make sense. That's where returning cash to shareholders could make sense. I think it becomes a lot harder for them to step into offshore or international because it's just not a core competency because they shed a lot of that core competency.
Hence your excitement over M&A.
Yes, and I think that's why we need to see more consolidation among those players. Those players don't have the organic capability themselves.
It is interesting, though, Neil, just to pick up on this. Even if some of those names combine, whoever they are, they still won't have those core competencies. So eventually, you're probably, as you look at the world and if the world is going in the direction of some competencies that you don't have, whatever space you're in, you probably have to start talking about and thinking about getting those. Yeah. And that is so you're going to go through a period of making some people nervous, I guess, is what
I think that's fair. And I think the market is differentiating. I mean, super majors trade at eight times EBITDA next 12 months. A lot of pure play EPs trade between 4 to 5 times. And so there is a big delta. The market is willing to apply a much higher multiple on companies that are able to operate in the entire global oil market versus those who are operating here in the United States and on a standalone basis. And so I think I think it makes sense for our companies to at least start to tool up their international capabilities, their exploration capabilities. Doesn't mean that they have to go full steam ahead, But EOG is a good example of a company who's putting their toe in the water. And I think it makes sense for companies to put their toe in the water here in 2026, because if you wait to 2031, when the Bakken and the Eagle Ford are very mature, and we'll even be talking about the Permian being mature, not declining, but mature at that point, it might be too late. So I think this is the time now to take calculated risk and look outside of the United States.
I mean, Maynard, we saw lots of examples when shale came about that the tight gas players, or even the first shale producers that ended up being too high on the cost curve, those that didn't make the diversification did not end up doing well, right? And so there's a assessment that would likely need to take place of how much running room do I have competitively positioned on the cost curve, and then if not, where do we need to go? And if I'm thinking about it now from an investor perspective as opposed to the corporate perspective, as an investor, I would only start to care about a business expansion, whether organic or inorganic, if I have enough confidence in that core competency, which was talked about, that there's the available capital, the returns, and the execution, which is actually an acronym for CARE if one wants to play the acronym game. And so you probably need enough of those boxes to be checked. Some companies will get the pre-credit, some companies will get the opposite of that, but ultimately, after a couple of years, enough of those boxes would probably need to be checked to be able to get a sustained amount of credit for that business expansion.
So maybe, Carly, I'll rope you into this because I think we're into this somewhat generic category of I'm a company doing something in this big soup, and I see opportunity in something that is not quite what I do. But I think the opportunity is significant. Any gut reaction to, because that means if you go that direction, there's just going to be, somebody's going to be annoyed with you. You got to hope it pays off. Any gut reaction to how you get outside your lane, take some risk, manage through it, keep your credibility, and make it to the other side if you're changing your business model? Because it seems like by creating this soup, which we all love, we love this great big energy power tech soup, you're going to get more mixed marriages. You know, something's going to happen in here, which will be different. How do people manage through that? Carly, I got to rope you into that terrible question.
No, I mean, I think we've seen some of this play out in the power and even traditional utility space, and those companies have historically been a bit slower to some new opportunities and slower to change. But I think we've seen some of the regulated utilities start to, in small doses, explore newer technologies, explore, things like Bloom fuel cells, where one of our utilities, AEP, announced, an upsizing of their agreement to procure more power from them to help support data centers. And by the way, they did that in a non-regulated market that was outside of their traditional footprint. But I think, again, it's about managing for power and utilities companies. I think it's about managing the commodity price exposure, managing the earnings volatility that would come with exploring some of those opportunities. So I think we've seen a lot of appetite to maybe go out along the edges if you're still able to provide visibility on a long-term contracted stream of cash flows. But I think if you saw a lot more of these companies venture into options out on the periphery that are giving them merchant or commodity price exposure that increases the volatility levels of the business, that's something that we would be probably less open to. And I think we saw that even a couple of years ago. The regulated utilities, a lot of them sold off all of their deregulated businesses as investors really pushed for a fully regulated business model with very low volatility of earnings, very low uncertainty. And you're starting to see some pockets of that shifting back. I don't think we'll swing fully back in that other direction. But you are seeing some shifts, but it's still on a contracted basis. There's very little willingness to take merchant exposure here. And we would agree with that tact. As we know, these markets are cyclical. And a lot of players, I think, have seen how these things can boom and bust.
So, Brian, you alluded to this. Here we are in this period of great growth. Like growth is just on the screen, power demand, technology, maybe even we'll see about economic growth. But when you're in a period of growth, Are investors, when they talk to you, are they, and all three of you, are they realizing, hey, in a world of growth, people are going to take more risks, and that's exciting, but I might not be able to get that absolutely predictable, not volatile, thing that I have been, I'm going to have to change my taste. Or just talk to us about how the investors are viewing all this potential growth, and does that mean are they themselves going to change a little bit?
I mean, I think we are seeing that, and really we haven't seen this demand-driven upcycle in energy and power since, I mean, Arjun, your super cycle back in 2003 to 2007. That was really, I think, the last time we saw a demand-driven upcycle, which was also timed with supply maturity in certain areas. And now we have it again, but in the power side of the equation. And I think it has taken a little bit of time to actually get the investment community not used to this type of environment to actually even price it in. And we would argue, based on our recommendations and views, there's still some upside left to actually appreciate the longevity of this growth. And so as more buy into it, there likely is going to be upward revisions to combinations of volume growth and likely earnings growth. And those that can actually execute with good return on capital will be the ones that will ultimately win in the longer term as you shift into that execution phase. But it's probably as good a time as any now, while we're in the hopes and dreams appraisal phase, to actually get some of these growth opportunities or risk taking, as you asked, and as Arjun very nicely highlighted today and at the conference, to be more appreciated if there is at least some level of confidence in having the core competency and the execution. So, in an environment in which there's supply shortages and while demand is growing, that's probably a good opportunity. But let's go back to the shale for one more time, because when you started to make that shift, who were the companies that benefited? Those that had scale. And actually, I think that was one of the takeaways that we had coming from the conference, is that we're starting to see some examples where scale is actually starting to become a point of differentiation. It's not just single asset, it's having assets. I'm thinking here on the power side. It's providing power consumers with assets at different points around the country. It's not just having the generation, it's also having the land. Connectivity to a broader grid may be a better long-term strategy, while in the near term, it's just about time to market, which may favor behind the meter. So you can start to see the evolution heading towards differentiation based on scale over time.
The U.S. is such a unique energy environment, right? It's got the greatest data center growth. It has an administration with very strong views, and also, we just saw Friday they jumped in on the PJM auction and how we're going to add capacity. So there's kind of political risk to it. There's a strong direction to it. There's the data center AI thing is concentrated here. The U.S. environment in particular, and you had Chris Wright speak, how does that affect what stocks you're recommending, what stocks you're staying away from, what sectors you're pushing people to? Because that, if you are a U.S. player in all this, it just means you have unique characteristics. Anything on that?
Yeah, I'll start, and Brian, Carly, definitely jump in. But I think our philosophy as a natural resources business unit has been to not fight policy, but to embrace it. And there is a clear commitment from this administration to support nuclear. We love Cameco. We love UEC. We think that there's some really interesting stuff across that chain. There's a clear commitment to work through the transmission and distribution bottlenecks in the system. And, we love the specialty contractors, the Quantas and the Mostechs of the world. And we think that this is an administration that is going to be much more willing to enable M&A. And I think that will result in the majors having a competitive advantage as they are able to opportunistically pick off assets, and an administration that is going to be much more open to international investment. And I think that creates optionality for some.
You mean investment coming in? So pick a name, somebody investing in
and
U.S.
out and out. I
And
think
out.
the Middle East is a good example of where when President Trump went through the Middle East, I think that opened up new markets for some of our big oil companies, for example. Alaska is a great example where Conoco has been it has a lot more, is doing Willow, which we think long term is going to be a good project, bumpy near term, but long term good project. But I think has underappreciated optionality. So from our perspective, the policy set of being pro energy that Chris Wright talked about, I think is something that is very investable. And I think investing behind greater electric infrastructure, need for new nuclear, and then greater consolidation, I think is fruitful and key to kind of our stock picking process. Now, of course, the risk behind investing behind any policy set is that policy administrations do change. And so we have the benefit, unlike the companies who are listening into this call, of changing our recommendations in a couple of years if the policy set changes. So I do not envy companies who have to make 15 to 20-year decisions. But for us who are making recommendations over the next 12 months, there's no reason for us to fight the policy set, especially going back to the first point. If the market is willing to price the upside from those policy sets on day one, over and over again. So that would be my perspective. But Brian or Carly, anything you'd add?
Yeah, I think the one piece that I'd add to what Neil mentioned, he covered a lot on the power side, is just affordability. It's been top of mind in really all of our conversations, especially about the regulated utilities. And as we look across the U.S. and see that 36 states have gubernatorial elections this year, that certainly does influence our recommendations on the regulated side, as we do expect the affordability rhetoric to be loud in a number of states, given where we've seen bill inflation average over the last couple of years. On the top end of that range, you've got states like Maryland and New York that have seen inflation 20% or higher cumulatively over the last couple of years. So a lot of states in PJM, I think we're focused on watching some of those election outcomes and the utilities that could be potentially impacted. I think if we look back to last year, New Jersey was the best example of a really loud election on affordability. And you saw that play out in the way that, the New Jersey utilities traded during the year. And so I think that is part of the playbook for 2026. Outside of that, Neil mentioned the investment in electric infrastructure, and we see a lot of opportunity on the T&D side, companies like Sempra, Xcel, AEP that are big players in the transmission space. We think there's a multi-year opportunity set for the capital investment for those companies.
Yeah, I think I would conclude that we always kind of talked about how difficult it is to align the energy stars, an acronym for supply, transition, affordability, reliability, and security. And different, from policy perspective, different administrations are going to emphasize different pieces of that. Arguably, maybe it's stars right now. But there's a lot in that, right? That means that there's a focus, and it would probably happen regardless of the policy, but there's recognition of the difficulty to meet demand growth and the need for more infrastructure spending. And so the stocks and the companies that Neil mentioned, and the companies in that power supply chain, from the critical materials to the engineering and construction and the contractors, to the industrial products, to those that are actually investing at a decent or regulated return to achieve that supply growth, we think those are going to be multi-year beneficiaries, including in 2020.
No one can match Brian, though Jeff Curry always tried with the acronym. So actually, the two of you always had that really in common, and we lack that at Veriden. We may need to think of some good acronyms. I might try and bring together some of what we've talked about in terms of taking risk, but policy with some of the global stuff. Carly's answer earlier that one of the things that hasn't happened is people haven't done greenfields. I think she was talking about power specifically. That's true in copper. It's true in a bunch of different areas. And we have a U.S. administration that is definitely embracing taking risk, whether that's what they did in Venezuela, whether it's taking equity stakes in companies directly, Molycorp, or it's called something different now, Intel, and a few others. We've got China, which I think our current president, more than anyone else, has changed the bipartisan consensus from embracing sort of the low-cost exports to China to say, no, it's bad for our trade, it's bad for our Midwest and all these kind of things. Their power market, as I think you all know, is almost 2.5 times the size of our power market. They grew over the last 10 years by the size of the US. And so when I think about our market where investors are saying, hey, we're bullish power, but don't you dare invest in anything. Hey, copper prices are way up, but don't you dare build a new copper mine. I believe Moly Corp and Intel have reacted well to the equity stakes. I don't know if that's coming to the oil sector or not. I'm not so much asking you for a prediction on that, but the sort of taking risk can cut both ways in the U.S. and it is a different environment. Everything's different about where we are today. I'm curious if you can react to maybe some of the risks of the risk-taking nature of our current administration.
Yeah, I think that it's a great point, Arjun, from a stock picker's perspective. When you're in investment mode, especially in oil and gas, that can be difficult. And long lead time projects are hard. And by definition, they take a long time. And the stocks often trade on the point where the project comes in and you go into harvest mode. And that was true for C&Q with Horizon. That was true for Chevron with Gorgon. That was true for Exxon, even with Guyana. That'll be true with others who are coming in flight. But it doesn't mean that you don't do the projects, because ultimately the value gets crystallized over time. And so I think we want our CEOs to be cognizant of the fact that it can create volatility in the short-term price and source of frustration, and know why that is. The investors aren't being irrational. Very few of them have the time horizon to look out 3 to 5 years. But ultimately, if it makes the business better, and you think you can execute it well, don't be afraid to do the projects, even if it's unpopular. Because, man, when some of these projects first came into service, or first are announced, or new risk-taking strategies, people were really negative on it. And we look back on it and say, man, that was really smart. And so I think that's our advice to CEOs is to take a little bit of a longer term time horizon. Understand the market won't be happy when you're in investment mode, but understand that you got to do this to make the businesses better. But also build sufficient contingency when you announce large projects, and so that there aren't major cost overruns. Build some cushion into the timeline as well. And so the conversation won't always be about how's the project performing, but also, so people understand that they have to be patient, but they don't have to worry about shoes dropping every 6 months.
I guess we have a proposed limit on credit card interest rates. We have most favored nation drug pricing, and I'm probably forgetting 20 other things. We've got the equity stakes. I guess I'm just not sure whether that poses a risk for either the oil or gas or power sector if they're deemed to somehow not be doing enough. I don't know. You don't have to answer, but that's what I'm wondering.
I think, Carly, that's a really important question in your space, right? Today we have the PJM stuff. I mean, maybe you can unpack that a little bit, but I do think affordability becomes a big issue, and it more so than oil. I feel like electricity is at the center of that debate right now.
Yeah, I mean, one place that we haven't seen a shortage of investment to build new stuff is on the regulated utility side. I mean, there's a number of big resource plan filings, a number of long-range transmission planning processes going on across regional grids. So I think we have seen, progress on that front with companies like Southern just added 10 gigawatts to their planning through 28 to 2030. Excel's got a bunch of IRPs outstanding. Duke's going to build, high single digits of gas by the end of the decade. So there are some companies that are adding that capacity, but to the point that we made earlier in terms of the certainty of the earnings, those are obviously regulated assets earning a regulated rate of return. So it does feel like the uncertainty in our coverage at least is pretty squarely on the independent power producer side.
Maybe just a final question from me. Neil, we spent a lot of time talking about power, talking about integrateds and diversifieds and upstream companies. Next 10 years, what
Yeah.
do you think strategically refiners and midstream companies should be doing? It's obviously been US, it's been shale. I know John McKay, I think, covers the midstream for you. I think you cover the refiners.
Yeah.
What do you think about the next 10 years from them as maybe shale plateaus? We can have different views on that, but the world changes.
Look, I think refiners are actually in a really good place over the next couple of years. There's not a lot of new capacity that's coming in over the next 5 years. There's a little bit in India in the very near term, but over the next 5 years, as China keeps its exports out of the market, and I go back to some of your research, Arjun, obliterating the peak oil demand thesis. That has now been, I think, absorbed by the market. Demand is going to grow. There's limited new supply adds over the next 5 years. I think refiners, it's okay. We're telling others to take risks. My advice to the refiners is just don't take risks. Enjoy the market that you're likely going to participate in, shrink your share count over time, and you'll compound value just like you have been.
So you don't want a refiner to backwards integrate into Venezuela?
I think we would prefer them not to. I think it does seem like there's refining capacity in Venezuela. These upgraders could benefit from refining expertise, but I think Valero will be very good just sitting there waiting for the barrels to come in, commercially optimize it, run their assets well. The piece that we want refiners to really focus on, because the world's going to need refiners to run hard, is focus on reliability and focus on just doing the best that they can to capture as much money as they can in the environment that we're in, because we are short refining capacity globally and in North America over time. Maybe not in moments of time, but over time. And reliability is really critical. And we went through a period of time where reliability wasn't that good. Last couple of years it's been better. But my fear is that as these companies are enjoying more profits and they have more finance people who are running these businesses as opposed to operational people who are running these businesses, what is the risk that they take their eye off the ball on ops? And ops and refining, as we all know, have to be close to perfect, because boiling oil is super dangerous. So that's my advice to refiners. To the midstream companies, there is an opportunity set to capture. That capture is still, it's around natural gas. We have so much gas in this country. And Chris made a great point. Over the last 50 years at the conference, over the last 50 years, gas supply has grown at 3% CAGR, oil's grown at a 1% CAGR. So for the companies that are exposed to natural gas and midstream, they are very, very well positioned. Look to solve the problems. Waha is a problem. ACO is a problem. Getting these smaller gas lines into data centers and power plants off the trunk lines is a problem. The opportunity set is enormous for these guys. Don't be afraid to embrace it and solve problems. So 2 different strategies. Refiners, run your existing business as well. Midstream, go out there and solve problems.
Just maybe one last point on my end, because we've talked about a lot here: supply, demand, policy, price, capital. There's one thing that I don't think we've talked about as much as people. And especially now that we're in a demand growth environment, particularly for power, are we actually going to see shortages, which we think there is some risk on the transmission and distribution side. But I think that's just another area to focus on among the theme here of reliability, execution, and meeting demand.
Yeah, and Brian, that was kind of lead into the question I was thinking about for you and Carly. We've talked about some really big, visible themes. We could debate how much demand is going to grow in power or not, but we're on the direction seems well defined. But as you think about the next 12 to 24 months, what would be for each of you your top underappreciated theme? I think about it could be both ways. Carly, as we're talking about risks, is there risks in ROE pressure for the regular? Just thinking about what would be an underappreciated theme in the context of what we know is a pretty robust growth environment.
Yeah, I think on the opportunity side, I think actually the grid maintenance and resilience investment need is underappreciated. We like to talk about the exciting data center load growth opportunities and the grid expansion opportunities, but really I think the majority of the investment we're still seeing deployed by a lot of utilities is just maintaining the existing age of their system and addressing the fact that a lot of our grid is nearing the end of useful life. And we think that investment opportunity set is quite robust. So I think that piece is underappreciated. And then on the risk side, I think you sort of hit it. I think it's the affordability potentially weighing on ROEs, not only at the state level, but also potentially at the FERC level, where historically FERC transmission ROEs have enjoyed a premium relative to state level distribution ROEs. But I think as we think about the affordability elements here, that is another lever to pull. And some of these utilities that have joined RTOs over the years are earning a 50 basis point incentive on their ROE for being part of that organization. And I think that's one piece perhaps that the FERC may take a look at and address to help support affordability across the U.S.
Yeah, I would reiterate that, and I think it's a really interesting point of, it's not just the final product; it's all the earlier parts in the supply chain and the infrastructure to get us there. And so, Carly made the point on transmission and distribution. The same thing applies to broader midstream. We may need X BCF a day of natural gas demand, but we're going to need a lot more capacity from a midstream perspective to be able to hit the peak periods where some of that average into that number. For nuclear, it's not just about nuclear generation; it's also about all three phases of uranium to get from point A to point B. And I think some of that is starting to be appreciated, admittedly, but that's going to be very, very necessary to be able to execute. And then to kind of go back to the point on people, I think that's of the major constraints on growing AI and broader power demand. That's the one that we're most kind of focused on as a real risk to growth, is whether the 500,000 new jobs that we think are going to need to be created to hit that 2.6% growth, of which 250 are in, or 200 are in the transmission and distribution side, whether the skilling is going to be sufficient to be able to meet it.
Hey, Jeff, the only thing I'd add is economic growth. I mean, Jan Hatzius, our boss, put out his outlook for 2026, and he had a very bullish GDP forecast for the United States and globally. In the last year, copper's up 30 to 35%, and banks are up 25%, industrials are up 20 to 25%, energy's up 2%. That's made sense to us because we've been in a period of oversupply, but if there is economic reacceleration, I think a lot of us in energy have forgot what that felt like. This is a point that Arjun made at the conference, and I agree with it wholeheartedly. And I think that's something to think about. And so for those of us who are calling for a tactical pullback in oil, maybe it's very easy to miss the big picture. The big picture is, if you want to play a cyclical acceleration trade, that energy's no different than copper, which is no different than banks, which are no different than industrials. It is a way of expressing that view, and I think that would be the upside trade. And this is the tension, I would say, having spent a lot of the period post the conference on the road. Our hedge fund shorter term clients, thinking about the next couple of months, are understandably cautious about the supply demand balance and are positioned more negative. What's interesting is our mutual funds, who have been more negative clients, are starting to cover that underweight and get to a little bit more of a neutral position, because they are saying top down, there's the potential for economic acceleration, and energy is absolutely a cyclical space that could participate in that.
Fantastic, team. This was absolutely the robust buffet that we knew it would be, plus some. Neil, I started with you. I'll end with you. This time next year, we talked about the soup that is energy, power, tech, policy, all these things. Is there another flavor coming next year? Are we going to have a robotics company? Are we going to have, like, what as the soup expands, what's on your mind that how you might expand it?
Yeah, it's a great question. I think there's so much more work we need to do on the metal side. And so we have an unbelievable commodities effort on the metal side, and we have a great global team. But whether that is copper, aluminum, rare earths, there's just so much to unpack. So a year from now, when we do this conversation, I think that is an area of secular growth and a way of expressing economic reacceleration that we'll be looking as a team to unpack a lot more in the year ahead.
That's a great way to end. It's a great lead in. Rare earths reminds me, you guys are rare friends. So we appreciate you. Thank you. Thanks for having us.
you.
Thanks for joining. And thanks to all of you for listening and watching.